One data point is about to get more attention than almost anything else in financial markets right now. A fresh reading on consumer price inflation. Traders are in a holding pattern ahead of the release. Bond markets are quiet. Stock moves have been muted. That kind of stillness often signals that investors are waiting before making their next move. And right now, this inflation report is the reason why. So why does one report carry that much weight? It comes down to the Federal Reserve and interest rates. The Fed sets the benchmark rate that influences borrowing costs across the entire economy. Mortgages, car loans, business credit lines, all of it. When inflation runs hot, the Fed tends to keep rates high to cool things down. When inflation eases, the case for cutting rates gets stronger, and lower rates tend to be good for stocks and bonds. That cause and effect chain is why a single inflation print can move markets in minutes. A number that comes in above expectations can quickly kill hopes for a near-term rate cut. A number that comes in below expectations can do the opposite, sending yields lower and stocks higher almost immediately. The Fed's target is 2% annual inflation. Getting back to that level has proven harder than many expected. Some measures of price pressure have eased over the past year. Others have stayed stubbornly high. That mixed picture is exactly why this report matters more than usual. Investors are not just looking for a number, they are looking for clarity on which direction things are heading. When the data drops, most of the focus will land not on the headline figure, but on what is called core inflation. Core strips out food and energy prices, which tend to swing sharply from month to month for reasons that have little to do with the broader economy, things like oil supply disruptions or a bad harvest. Core inflation gives a cleaner read on the underlying trend, and it is the figure Fed policymakers tend to watch most closely. A core reading that comes in hotter than expected would likely push back the timeline for rate cuts. One that surprises to the downside could bring that timeline forward. Either way, bond yields are likely to move fast, and stocks will follow. The broader backdrop matters here too. The Fed has been trying to slow inflation without tipping the economy into recession, a difficult balance that has produced conflicting signals in recent months. This report will not settle every question, but it will sharpen the picture. Watch the core number closely. That is where the real signal tends to hide. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.